Welcome back to the Explainer. So if you've been keeping an eye on the financial markets lately, you absolutely know there's a massive event brewing on the horizon. But here's the thing. When a company goes public, they don't just send out a simple, easy-to-read memo. They file what's called a red herring prospectus. It's a dense 400-plus page legal document packed to the brim with regulatory jargon, tiny font, and just endless disclaimers. But don't worry, you're not going to have to read it, because today, we're cutting right through all that noise. In this explainer, we are extracting exactly what you need to know about this highly anticipated IPO, straight from the source material. We're going to break down the sheer magnitude and the underlying mechanics of this major financial milestone. Okay, let's dive right into this. At the absolute center of our breakdown today is a literal giant in the Indian financial landscape, SBI Funds Management Limited. Originally incorporated way back in 1992, they have been a colossal player in asset management for decades now. But today, they are stepping into a brand new chapter by finally opening their doors to the public market. To make sense of this massive offering, we're going to untangle this prospectus into 6 quick, logical chunks. First, the big SBI IPO. Second, breaking down the offer. Third, promoters and key players. Fourth, who gets to buy. Fifth, weighing the risks. And finally, important dates to remember. All right, let's kick things off with Section 1, the big SBI IPO, where we look at the sheer scale and scope of this event. This is a 100% book-built offer, and the volume here is just staggering. We are looking at exactly 203,709,239. That is the absolute maximum number of equity shares with a face value of 1 rupee each that will actually be up for grabs. When you see a number like that hit the market, it immediately signals the immense scale and institutional gravity of this offering. It is a monumental liquidity event, for sure. Moving right along to Section 2, breaking down the offer. Let's look at the actual mechanics of the sale. And this brilliantly illustrates the true nature of this IPO. If you look closely at the prospectus, under fresh issue, the number is literally 0. Not a single new share is being created here. Instead, 100% of this transaction is what's called an offer for sale, or OFS. So what does that actually mean for us? Well, it means SBI Funds Management Limited, the company itself, isn't actually raising any new capital to fund future operations or pay down its debt. Rather, this IPO is purely a mechanism for the existing owners to sell their shares directly to the public. Which brings us nicely to Section 3, promoters and key players. Basically, who exactly is cashing out here? The prospectus clearly outlines 2 major promoters who are unlocking their investments. First up, we have the State Bank of India, and they're offering up the lion's share with up to roughly 128.3 million shares. The second player is Amudi India Holding, a major global asset management partner, and they're offering up to 75.3 million shares. Put those together, and they make up the absolute entirety of that massive 203 million share pie we talked about earlier. Now, what's really fascinating about the slide is the historical context. The regulatory filings mandate that promoters disclose their weighted average cost of acquisition. In plain English, that's essentially just what they originally paid for these shares. Get this, for State Bank of India, they originally paid a mere 15 paise per share. Yeah, 15 paise. For Amundi India Holding, it's 4 rupees and 35 paise. Regardless of where the final IPO price actually lands, this just highlights the incredible long-term value these promoters have built up within the company over decades before finally deciding to offer it to the public. Of course, bringing an offering of this astronomical size to the market requires some serious institutional muscle. The prospectus lists a veritable who's who of global and domestic investment banks acting as book-running lead managers. We're talking absolute heavyweights like Kotak Investment Banking and Axis Capital, alongside others like Botha Securities, HSBC, ICICI Securities, Jefferies, JM Financial, Motilal Oswal, and SBI Capital Markets. Having a syndicate this expansive really underscores the sheer complexity and the global reach required to manage a book-building process of this magnitude. Let's pivot now to Section 4. Who gets to buy? We need to talk about allocations and reservations. The Securities and Exchange Board of India dictates some pretty strict quotas here. Up to 50% of the net offer is reserved specifically for QIBs, or qualified institutional buyers. Then, not less than 15% is set aside for non-institutional bidders. And the remainder of the net offer goes to retail individual bidders. But pay close attention to the specific reservations on the bottom there. They've carved out up to 270,000 shares for eligible SBI FM employees, nearly 3 million shares for eligible State Bank of India employees, and a whopping 13 million plus shares strictly reserved for eligible existing SBI shareholders. And if you happen to fall into one of those employee buckets, well, the prospectus buries a really interesting perk in the fine print. It states that the company, in consultation with those lead managers, may actually offer an employee discount on the final offer price for eligible SBI FM and SBI employees bidding in their respective reservations. It's a very strategic move, often used to reward loyalty and just ensure really strong internal participation in the public offering. All right, moving to Section 5, weighing the risks. It is time for a quick reality check. As an objective explainer, we absolutely have to look at the mandatory risk factors. I want to read this exact quote directly from page 24 of the document, under risks in relation to the first offer. It explicitly states no assurance can be given regarding an active or sustained trading in the equity shares, nor regarding the price at which the equity shares will be traded after listing. That right there is the authentic, sobering legal weight of the prospectus. It's a stark reminder that, hey, despite the legacy of the promoters and the backing of all those top-tier investment banks, this is still the company's very first time on the public market. There is zero historical trading data here, and once that bell rings, market forces, not past performance, will entirely dictate the stock's future. Finally, Section 6, important dates to remember. Let's look at the actual IPO timeline. So the absolutely crucial point to take away is this tight, highly anticipated window coming up in July 2026. The action officially kicks off on Monday, July 13th, exclusively for anchor investors. You know, the massive institutional buyers who come in early to set the initial momentum. Then the bid officially opens to the broader public the very next day on Tuesday, July 14th. And you only have a 3-day window here because the offer definitively closes on Thursday, July 16th. Basically, everything we've discussed today culminates in those rapid 72 hours. So we've taken a deep dive through the red tape, we've uncovered the massive 203 million share offer for sale, those extraordinarily low acquisition costs for the promoters, the intricate web of buyer reservations, and of course the unvarnished risk factors. Now, the theoretical becomes reality. With this massive volume of shares hitting the market and zero new capital entering the company itself, we are left with one critical question. Will the book-building process ultimately value the company as highly as the market anticipates? It is going to be incredibly fascinating to watch the real-world results of this massive IPO unfold. Thank you so much for joining me on this explainer, and as always, keep learning.